for this special presentation designed specifically for individuals in the medical profession. Today we'll be sharing with you some how you can be leveraging advanced tax strategies to be able to keep more of what you earn, because after all, it's not just what you earn. Ultimately, it's what you're able to keep. I'd like to begin by introducing myself. My name is James Nefko. I am the head of advanced planning here at Peachtree Planning, a firm that has a long track record in the Southeast. We engage in full-scale comprehensive planning for individuals and for business owners. And we have an approach, a very comprehensive approach, where we engage other types of professionals to make sure that our clients have well-rounded and very customized financial plans. And today, specifically, I'll be talking about how we can be working with your tax professionals to ensure that you are able to keep as much as you possibly can when it comes to avoiding unnecessary taxation. I think it's good to just take an overall view of the historical tax rate environment. Obviously, we are in a time now where tax rates are historically low. The top marginal bracket is 37%, but that hasn't always been the case. If you look at this overlay of historic tax rates, which is the blue and the green lines, and the gray area is total GDP. And if you think about times in our past, in this country's past, where we sustained a lot of debt as a country, typically taxes tended to be higher. If you look back at the spike in the mid-40s, we had a tremendous amount of debt because of World War II. And at that point in time, tax rates skyrocketed. The top marginal bracket was all the way up to 94%. Well, we have similar levels of debt today, and we have not seen an uptick in the tax rates. In fact, in 2017, with the passage of the Tax Cuts and Jobs Act, we saw a slight reduction. But the question remains, what will taxes be like going forward? And certainly we see a lot of headlines, a lot of news that suggests that taxes could in fact be higher. There's obviously a lot of political noise going on. We are gearing up to enter an election year. And the fact of the matter remains, we are carrying very high levels of debt as a country. So it's critically important to make sure that as a part of your overall comprehensive financial plan, we have ways that we can help you not pay more than you're legally obligated to pay. In fact, that is a view that has even been expressly promoted by the Supreme Court. This is a quote that specifically says, over and over again, courts have said that there is nothing sinister in so arranging one's affairs as to keep taxes as low as possible. Everyone does so, rich or poor, and all do right, for nobody owes any public duty to pay more than the law demands. That's a quote from 1934. And it really begs the question, how do you know if your affairs are so structured that you're not paying more than you should? Have you had proactive tax conversations with your tax advisors? That's one of the benefits of working with our firm. We actually engage your tax advisors, and we make sure that they are aware of all of the proactive tax planning strategies that are at their disposal. So when we think about these tax planning strategies, they're really very closely related to a variety of different areas that involve your money, whether it be in regards to accumulating wealth, earning an income and investing that income. That all has tax implications. When it comes time to actually begin living off of the money that you've saved in retirement, structuring retirement income distributions so that they are as tax efficient as possible is also extremely important. And when we think about transferring wealth to the next generation or engaging in a variety of different estate planning techniques, all of these areas involve taxation, and mistakes can be extremely costly. So it's important to work with an experienced team of advisors that can really make sure that you are getting everything you can in regards to not paying more taxes than you're legally obligated to pay. So let's dive in to some of these strategies. And the first one that I'm going to share with you is in regards to a concept known as asset location, and then we'll discuss tax harvesting here in a second. You've likely heard the importance when it comes to investing. You've heard the importance of asset allocation, being properly diversified, not having all of your eggs in one basket. The same thing holds true for the notion of asset location. And essentially what this is suggesting is making sure that you are building out multiple different buckets with your wealth, not leaving all of your wealth in taxable or tax-deferred accounts, but utilizing all the different types of buckets that you have access to. So for example, there are really 4 key different types of buckets when it comes to the taxation of retirement accounts or investment accounts. You think about taxable accounts, investing accounts, brokerage accounts, mutual funds. Those are types of accounts that are held outside of your retirement plan that are generating taxation each and every year. As a mutual fund buys and sells individual securities inside of that fund, it's going to generate some tax liability to the mutual fund shareholder. We think about tax-deferred accounts. These are the types of accounts that most Americans use to save for retirement. Oftentimes they are provided by your employer, and these types of accounts may consist of IRAs or 401ks. If you're self-employed, maybe you have a SEP IRA. If you're a teacher, maybe you have a 403B or a 457. But when it comes to you as medical professionals, depending on how you're structured as a practice, really it warrants further consideration to see exactly what type of tax-deferred retirement account you may have access to. And we can certainly help you in that regard as well. We have tax-exempt accounts, accounts that are exempt from tax at the federal and or a state and local level. These types of accounts may hold municipal bonds or U.S. treasuries. And then finally, we have tax-free accounts, things such as qualified distributions from a Roth IRA. And worth noting, cash value inside of life insurance and the death benefits associated with life insurance are not subject to tax. So we have 4 different types of buckets, 4 different types of accounts that we can strategically locate our assets, locate our investments inside of those accounts to make sure that we're not unnecessarily generating taxable income, and we're taking the most tax-inefficient investments, and we're wrapping them in protected wrappers. We're taking very tax-efficient investments, and we're not as concerned about having a protective tax-deferred wrapper on those types of investments. So that's really the first concept, making sure that we're not only utilizing asset allocation, but we're also utilizing this concept of asset location. Now, these types of strategies can really be pursued when it comes time to determining what tax rate you're actually in. Folks in higher tax brackets likely will want to begin utilizing different types of tax-free accounts. But really the strategy will depend on what bracket you currently find yourself in. As a successful medical professional, I would warrant a guess that your tax rate is likely on the higher end of the scale. And so it warrants being aware of all of the different types of buckets that you have access to and making sure that you are strategically utilizing and deploying each one of those buckets. The strategy that we help people with also can be dependent not only on income but also on age. When our clients are in their early accumulation years, which would range from the age of 25 and 45, we may utilize things such as maximizing their qualified retirement savings and maximizing their IRAs, beginning to build out those tax-free buckets that will get the benefit of compounding growth over a long period of time, like a Roth IRA or a Roth 401k. Even beginning to build cash value in a permanent life insurance policy. Perhaps for very high income earners, we may want to explore deferral utilizing some type of annuity that would allow for tax deferred growth. So in these early years, the key is maximizing your savings and also utilizing these types of buckets to begin accumulating wealth, but doing so not just simply relying on the qualified plan that's provided by an employer, but building out these multiple buckets so that when it comes time to retirement, you're well positioned to be able to distribute from these different types of accounts. When we work with clients that are, say, 46, they're not quite to retirement, they're 46 until they get to retirement, they find themselves in this age range, we're going to continue to apply the key concepts from the early accumulation years, but we may begin to aggressively manage taxation of wage earners as folks get into their higher earning years. And then at retirement, we're going to evaluate things such as rolling over pensions, evaluating asset protection issues, which is likely something medical professionals need to consider well before retirement, making sure their assets are creditor protected. We're going to begin to manage qualified Roth distributions. We're going to utilize Social Security strategies that will maximize Social Security. So the planning that we do is both tax rate dependent and it is also age dependent. We think about once folks are actually in retirement, what are some of the things that we need to be aware of? Possibly waiting as long as possible to take distributions from our qualified accounts, which currently the age for a required minimum distribution is 70 and a half. But stay tuned for some additional information on that as we get towards the end of the presentation. If we've done our job correctly in working with clients when they begin to engage us, when they get to retirement, they have multiple different buckets from which they can draw, which means if we find ourselves in a higher tax rate environment in the future, these clients have flexibility. They're not totally dependent on a tax-deferred account, which when that distribution comes out of the tax-deferred account for retirement income, it will be exposed to taxation. And so getting these buckets built as early as possible is critically important to provide the most flexibility for when you are beginning to take your retirement income distribution. When we think about tax gain harvesting, there's a couple of noticeable things that we need to be aware of here. And again, this can be dependent on where you fall in the tax brackets, and it can also be dependent on where tax rates are currently set. When it comes to long-term capital gains, again, we're at a pretty historically low level of capital gains tax rate. So it can make sense to sell those assets with long-term capital gains in a year in which we're in a lower bracket, in a year in which we are get the benefit of lower capital gains tax rates. So the notion of being strategic with liquidating assets to harvest gains, liquidating assets to harvest losses, that's where professional wealth management services like the services our firm can provide can allow you to get very strategic in managing those investment assets, not only from an asset allocation standpoint, but also from a taxation standpoint. So another concept that I think it's important to be aware of, specifically as it relates to folks in the medical profession, is this new tax provision that was introduced in 2017 that became effective in 2018, and that will be the law of the land at least until the end of 2025, is the notion of the provision that's often referred to as 199A. With this provision, for practices that perhaps are set up as professional corporations and have elected to be taxed as an S corporation, the 199A deduction potentially allows a medical professional to deduct up to 20% of their qualified business income. And by getting access to this deduction, it has a tremendous impact on the amount of taxes that ultimately you will pay. But when it comes time to determine whether or not somebody is entitled to this deduction, there are some limitations. For those individuals that are deemed to be specified service providers, once income is over a certain threshold, in 2018 it was $415,000, in 2019 it will be $421,000. Once income is over that threshold, you no longer get the benefit of a 199A deduction. So what does it mean to be a specified service business or a specified service provider? Unfortunately, for those that are engaged in the medical profession, especially in the practice of medicine, you are deemed to be a specified service provider. So what does that mean? Basically, we need to be very aware of your income. And if your income is going to be over the threshold that would negate your ability to actually get access to this deduction, we need to bring some strategies to the table to potentially reduce your taxable income and therefore be able to get the benefit of this deduction. So when we think about ways we can help you do that, going back to my comment earlier in regards to making sure that you have the right type of retirement plan in place so that you can maximize your retirement contributions, I think it's interesting to look at the different types of plans that are out there and what those contribution limits are associated with each one of those plans. A typical 401k, you're going to be capped out at a $19,000 contribution. Your IRAs, you're capped out at $6,000, and your deductibility could also be impacted by your income. Your ability to participate in a Roth IRA is impacted by your income. But for those medical professionals, again, structured as pass-through businesses from a tax standpoint, I strongly encourage you to explore with us whether or not it would make sense for you to have a different type of qualified plan, a cash balance plan or a defined benefit plan that would allow you to contribute substantially more than these traditional retirement plans allow you to contribute. In some cases, depending on your age, we may be able to make contributions into these retirement plans in amounts well over $200,000. Money that you're putting away for your future retirement, but money and contributions that's also reducing your taxable income and therefore potentially, depending on your income level, potentially opening the door to being able to claim a 199A deduction, which again would be 20% of your qualified business income. So substantial opportunities here to make sure that you are structured appropriately and make sure you have the right types of retirement plans, to make sure that your investments are housed in the right types of accounts in order to make sure you're not paying unnecessarily high taxes. So the third strategy that I'll share with you today is in regards to gifting. We work with a lot of individuals that want to begin exploring the ability for them to make a gift for children, for grandchildren. Anybody can make a gift and not have that gift be taxable as long as the gift is $15,000. The recipient doesn't pay tax. The person giving the gift doesn't pay tax. But once you get over that $15,000 mark, then you begin to be exposed to gift tax. But there are a lot of strategies that we can utilize that can help you achieve your giving desires or your charitable inclinations and help you do so without being exposed to gift tax. For example, 529 plans, typically utilized for higher education purposes, for kids or for grandkids. Given the new tax bill, it can also be used for private education K through 12. An individual can combine 5 years worth of gifts and combine that and make that one-time gift into a 529 plan. So, and spouses can join together and combine 5 years worth of gifts and put that into a 529 plan for a child or a grandchild. When it comes time to charitable donations, there are numerous charitable giving strategies that can allow you to contribute substantially more and claim very large deductions when it comes time to give those charitable gifts. And one of the strategies that many of our wealthy clients are considering and exploring and implementing is the ability to transfer wealth now, because the unified credit, the estate and gift tax exemption right now currently is so high. It's essentially $11.2 million for an individual. And when combined with a spouse, that number is north of $22 million. $22 million that can pass to a non-spouse, to a child, to a grandchild without any estate tax. The challenge with our exclusion rate being so high right now is the fact that it is set to sunset at the end of 2025, where we will revert back to what the exclusion amount was prior to 2017. So thinking through the ability to make transfers now and have those transfers be out of your estate, so that if the estate tax exclusion drops back down, you've protected more of your wealth from unnecessary tax by utilizing the higher gift tax exclusions now. And finally, when it comes to gifting, for those of you that are over 70.5 and you have required minimum distributions, if you do not want your distribution, you can elect to send it directly to a charity and have it be considered a qualified charitable deduction, so you do not have to recognize tax on that distribution. So gifting can be a valuable way to offset taxes, not only in the sense of fulfilling desires to help those that you want to be benefactors for, but also from a wealth transfer and from an estate planning standpoint. There are numerous strategies in that space. So where are we now? And what is coming down the pike? I mentioned earlier, it's highly likely that tax rates could be higher in the future. But what are some specific proposals that we've seen that would actually impact taxes in 2020 and beyond. The first one, a piece of legislation that was actually introduced earlier this year that has not become law yet, but is potentially will become law sometime soon, is in regards to the Secure Act. And some key provisions inside of the Secure Act include RMDs, your required minimum distributions, being extended, not beginning at 70.5, but being pushed back to 72. So it's giving the retiree longer time before they have to actually take a distribution. There are also no limitations on the age limit for IRA contributions, and those are currently phased out at 70.5 as well. Retirement accounts must be withdrawn primarily in 10 years of the owner's death. Now, this is really important as you consider transferring wealth to the next generation. The way the law currently stands is a beneficiary of a retirement account can elect to take those inherited assets in a variety of different ways. Sure, they could choose to take it all via a lump sum. They could choose to take it out over a 5-year period of time. But from a tax standpoint, the most advantageous way for a beneficiary to receive these assets is to use the beneficiary's life expectancy to gradually deplete that account. It's known as a stretch IRA, and it allows smaller distributions to come out, so less is actually being taxed. And the benefit of taking smaller amounts out beyond the tax savings is the fact that the undistributed portion continues to grow in that tax-deferred wrapper. So this is significant, and it's also potentially going to be very problematic for families that are attempting to transfer wealth in the most tax-efficient way possible. They are going to find, if this law comes in place, and if they have not engaged in proactive planning in this regard, they will find that those assets are actually distributed much quicker to the next generation and imposing more of that wealth to tax. The good news is, if we can get ahead of this, we can certainly structure your situation in such a way that you can transfer wealth, as much wealth as possible, in the most tax-efficient way as possible. So the Secure Act is something that we need to keep an eye on, and that is one of the roles that we play here. We are structured in such a way that we are willing to engage your existing providers, your existing professionals, and make sure that all of us are working together on your behalf. We maintain a non-emotional perspective. We're avoiding knee-jerk reactions, and we are building out a comprehensive plan, being very proactive, being very strategic. We can be in a position where we are helping you make the types of decisions that you need to make in order to accomplish the things that you want to accomplish. What's your vision? What is your purpose? What are the ideal outcomes that you want to achieve through the course of your life? To accomplish those things, it takes planning and it takes time, but it takes well-skilled, highly skilled professionals to be able to help you make sure you're structured in such a way that you are not paying more than your fair share in regards to a tax liability. So we'd like to help you do that. We appreciate the opportunity. We appreciate you taking your time and learning more about some of these advanced tax strategies that medical professionals need to be aware of. And we would certainly appreciate the opportunity to explore these things further with you. We will reach out and provide some additional information over the coming days. And thank you again for taking time out of your day to join us during this call. Thank you.